The divergence to the financial markets. Divergence, as the name of the suggestions, forms when the oscillator and the price actions fail to converge. If you analyze the price actions in the chart, you will notice that the price moves ups and down formations, peaks and valleys. These are the exponentials and contractions, or those are retracements for the experienced traders. Trading based on the price actions alone might already be profitable. However, many other traders also prefer the secondary confirmations of their setups. So they use the indicators, some applied on the price chart, while others are oscillating indicators on the different window on their platform, usually at the bottom of the main charts. Under normal conditions, price actions and the oscillator tend to move in the same directions. When the price makes the new high, the oscillator is also prone to make the new high. Likewise, when the price makes a new low, the oscillator is also prone to make the new low. When the converge fails, what you basically get in the divergence. The divergence is the leading indicators of the price actions. On the words, in other words, when you see the divergence, there is the high likelihood that price actions will potentially make a revenue. There are many different types of the divergence available. On the divergence, I categorized into the regular and the hidden divergence, while the regular divergence is easy to stop to the hidden. Divergence are less rare and require some practice to spot them within the hidden divergence. You have the bullish and the bearish divergence. If you look closely at this chart, you will notice the MACD indicator moved up and down corresponding to the price movements. However, if you also look closely, you would also notice the instance where the peaks and the wave heights and the depth would differ from that of the price chart. These are what we call the divergence. It is basically a disagreement of the height or depth. The price charts and the indicator speaks and the waves distance disagreement is telling me that even though the price chart has already formed a low that might not be that deep, mathematically the indicator is showing that the retracement is already deep enough. This indicates that price is ready for the sharp reverse. That types of the divergence is called the hidden divergence, which usually significant the levels of the short retracement, where better said a continuation of the existence trend. To remember, the hidden divergence usually correspond with short-term retracements. How does the hidden bullish divergence work? A hidden bullish divergence works based on the concept of the lows in price and the lows in the oscillator, while the trade with divergence, what are the regular indicators? A reversal of trading price actions. Hidden divergence is the indicator that the trend will continue. I like consider a hidden divergence as the end of the pullback. In order to identify the divergence, you basically need an oscillator, any type of the oscillator work. In this case, the most commonly used oscillator on the relative strength index, the stochastic oscillator, and the MACD, the custom oscillator, and money flow index are also great indicators to spot hidden divergence. This example, you have the basic illustrations of the hidden bullish divergence. In this chart, you can see that the price makes the higher lows compares to the individual. However, every assigned indicators make a lower low relative to the previous low. This example shows another hidden bullish divergence using the stochastic indicator and the clear uptrend, as you can see comparing the lows in the price. and the lows in the oscillator. The Heightened moving divergence is formed after the formation of the higher low in the price, then sugar to the new high. Should be noted that the Heightened moving divergence can form anyway in the trend. Typically, through the Heightened moving divergence are usually found in the uptrend. It forms close to the highest to the price actions. Portability with the Heightened moving divergence signals that there is a strong probability of the price continue to the uptrend. Also pay close attention to the higher lows formed to the end of the pullback price actions. Candlesticks patterns can reserve as the great confirmation tools to the continued trend. The next type of the trade divergence is the heightened bearish divergence. In the bearish heightened divergence, the price makes lower heights, but you will see later makes the higher heights. This type of the pattern occurs mainly during the downtrend correction. In this example, we see what while the price have the continue to go lower is formed lower heights. The arrow PSI oscillator made the high heights. This is what we call hidden bearish divergence. Divergence theory tells us what there is the strong probability that the downtrend will continue. Basically, a hidden bearish divergence pattern means that the trend is continue to the downside. And here's another hidden divergence, this time which is stochastic recent price actions indicate a down momentum with the price making lower heights. However, despite the fact that the price is making the lower heights, the stochastic record high heights, those forming the hidden divergence, and the signaling the bears were in the strong positions to enter the market of the two types of the divergence, regular and heightened. The heightened divergence represents the higher probability patterns. This is based on the fact that the heightened divergence is trend continuations leading signal. Now that we identified the main type of the hidden divergence, how you trade them, the hidden bullish divergence method can be used in the number of the ways due to the fact that the hidden bullish divergence is the leading indicator. It can potentially tell you what could happen next in the price, generally speaking, when the hidden bullish divergence is formed to you. Get in long positions, and when you stop the hidden bearish divergence, be prepared. The search for the short trades, the oscillators they used in the previous examples, where the RSI, stochastic, and the MACD. These probably the most common oscillators for the decaying divergence, but they are the substantial number of the oscillators very useful to trade the divergence. Now, from my experience, the most ideal place where the hidden bullish divergence can occur is at the end of the downtrend, near the bottom of the downtrend. Hidden bullish divergence can be powerful trading signals. For this example, we have hidden bullish divergence that is formed near the bottom of the downtrend. If you closely observe, what you first see is the minor correction in the price. This leads to the higher lows in the price, and at the same time the relative trend index indicator forms the lower lows. That divergence then leads to the uptrend of the ways to trade the hidden bullish divergence is to wait for the error side of the cross in the 50 levels. Also pay attention to the candlesticks formations, pin bars, and full candlesticks are great confirmation patterns that bull are prepared to the push price higher. Also trading breakouts and the breakouts of the keys resistance and the lower time frames are also very strong signals that the hidden divergence could prove to be successful after the entry. The trade, the stops are placed at the higher low in the price. Following this aim for a 1-to-1 what I want to the risk reward setup, as to you can see the example of the price actions eventually reach the target. However, not all hidden bullish divergence are successful. You can find any example of the failed hidden bullish divergence. The most common mistakes what inexperienced traders make would be mistake false hidden divergence. scenarios. As green light to get started things trading. For the instance, in this example, looking for the downtrend, you spot that the hidden divergence starts much easier than the official top. That's why when the spot inceptions of the hidden divergence, don't enter to the market blindly. You need to the confirmations from the price actions first, and from those later second to the hidden bullish divergence can fail when the price fails to the new heights. That's why you should consistently pay attention to the price actions. This example shows the failure hidden bullish divergence. Here also price actions jumped higher after the positions the higher lows price failed. To maintain the gain to the sure, if you entered early at the stochastic crossover, this trade would have to brought some profits following the swing heights. That is formed price actions barely testing in the height, and then drops off. This leads to the downside corrections. In the piece, as you can see, while this looks like the failure hidden bullish divergence, you can see that the failure of the swing heights leads to the price positions on your all your downside price is the king. That's why you need to divide the guide, so you the big point to remember that when the hidden bullish divergence forms near the top of the array, you can accept to see the topping pattern being formed in the hidden divergence patterns. Fails, you can expect to see the reverse on the lower side. Here are the other example of the successful hidden divergence patterns. The hidden divergence is exceptional market tool that can pointing areas to enter the market and eliminates some of the guesswork created by false trading signals. Divergence, although not perfect, are very powerful techniques to use since the hidden divergence usually occur the mirror retracement of the probability of the successful traders. Is the higher sense chance as you are still trading with the trend and not against of you learn something new and find value. Give us a like to show your support, and make sure to subscribe to click to the bell icon to stay in touch with the new when we upload the new video. Until next time.